Welcome back to the deep dive. Today, we're digging into a fascinating question, one that's really got the financial world buzzing.
hmm
Why is Barrick Mining, one of the globe's leading gold producers, trading at such a significant discount to its peers, especially now with gold prices hitting record highs?
Right, it's a real puzzle.
Is this a classic case of a deeply misunderstood value opportunity, or is there some hidden risk the market perceives that maybe we're not seeing clearly? That tension, that mystery, that's exactly what we're here to unravel for you today.
That's absolutely right. Our focus today is squarely on Barrick Gold Corporation. Ticker symbols are GOLD on the NYSE and ABX on the TSX for those tracking.
Good point.
And just to be clear, all our analysis is current as of August 11th, 2025. Barrick's NYSE share price closed at $21.16 on that day, and all the data we're discussing is benchmarked right there.
Okay, perfect. I'm really looking forward to unpacking this one. It feels like there's a lot underneath the surface.
There is.
So, to help us navigate this intriguing mystery, we've structured this deep dive into two main parts. Sound good?
Yep, makes sense.
Okay, in part one, we'll lay the foundational groundwork. We'll cover their business analysis, evaluate their management, which is key here, and dive deep into their financials.
The nuts and bolts.
Exactly. Then in part two, we'll shift our focus. We'll look at market sentiment, their ownership structure, a crucial risk assessment, can't miss that, and finally bring it all together in our overall conclusion.
Sounds like a comprehensive plan.
Great. Let's jump right in. Chapter 1, Business Analysis, the foundation of a mining behemoth.
All right, so first off, Barrick's core business model. They are a senior gold and copper miner, a producer.
Okay, and that distinction matters, right? They're not just financing.
Absolutely vital. You need to differentiate them from, say, royalty companies that just finance operations or junior explorers who are purely focused on discovery. Barrick actually digs this stuff out of the ground,
Right.
which means their value is directly tied to how well they run their mines, manage costs, and, well, the sheer volume they produce. Operational efficiency is everything.
And it's interesting, they aren't just a pure gold play, are they? I hear a lot about copper, too.
Exactly. You're spot on. Their revenue streams have this dual focus, gold and copper. For instance, just look at Q2 2025. They produced just under 800,000 ounces of gold. Significant.
Wow. Yeah.
But they also produced a substantial 59,000 tons of copper. That's about 130 million pounds.
So that dual focus, is it strategic? Hedging bets?
Very strategic. Gold gives them exposure to that traditional safe haven asset, the inflation hedge, geopolitical uncertainty buffer.
Yeah.
But copper is absolutely critical for the global energy transition.
Ah, the electrification angle.
Precisely. We expect that to be a multi-decade trend, so it's a long-term play for them.
So they're pulling a lot of metal out of the ground. Where exactly are they doing this? What's their geographic footprint look like globally?
Barrick's operations are pretty well diversified, actually. Right.
They
operate across 3 key regions.
Okay.
North America is really their bedrock. Huge gold production there, mainly through that Nevada Gold Mines joint venture with Newmont.
Right, the NGM. That's the stable, low-risk zone.
Pretty much. It's their most stable and lowest risk operating environment. It's the anchor.
Makes sense.
Then you've got Latin America and the Asia-Pacific region. They contribute a sizable chunk of their gold, too. Think major assets like Pueblo Viejo in the Dominican Republic, Veladero in Argentina.
Okay, big mines there.
Huge scale.
Yeah.
But they also come with more complex political and regulatory environments. It's not always smooth sailing.
I can imagine. And the third region.
Africa and the Middle East. This is where you find some really high-quality, long-life assets. Loulo-Gounkoto in Mali, Kimbali in the DRC. These are crown jewels, incredibly productive.
I sense a but.
But they are situated in jurisdictions with, let's say, elevated geopolitical risk. And that, as we'll keep coming back to, is absolutely key to understand the Barrick story and that valuation discount.
Yeah, that geopolitical risk seems like a constant shadow for miners. Okay, let's talk reserves. I've heard some discussion about their ore grades may be declining. What's happening there?
That's a fair question. Look, the mining industry as a whole is facing declining ore grades. It just means less metal per ton of rock you process. It's getting harder.
Right.
Now, Barrick's average gold reserve grade did decrease in 2024, but, and this is important, it wasn't really a sign of weakness in their existing mines.
Oh, so what was it?
It was a deliberate strategic choice. They incorporated the massive Reko Diq copper-gold project in Pakistan into their reserve base.
Ah, Rayco Dick, that's huge, right? But low grade.
Exactly. It added something like 13 million ounces of
Sure.
gold reserves, but yeah, the grade is very low, around 0.28 grams per ton. So mathematically, it pulled the average down.
So it's a trade-off. Lower average grade now for massive long-term production, especially copper.
Precisely. It's a strategic trade-off for long-term production and fulfills their vision of becoming a major copper producer. It absolutely highlights their long-term thinking, even if it impacts a headline number like average grade today.
Okay, that makes sense. And with rising costs hitting everyone, how's that impacting Barrick's operations? What's their all-in sustaining cost, the AISC, doing?
Yeah, AISC. That's the really comprehensive metric for a miner, right? Captures pretty much all the costs of actually getting the gold out and sustaining the operation.
Yeah.
And Barrick's AISC has definitely increased significantly since, say, 2020. For 2025, they're guiding to a range of $4,462 to $560 per ounce.
Ouch. That's quite a jump.
It is, and it directly reflects those broad inflationary pressures we've all seen. Energy, labor, steel, reagents, you name it. It's hit the entire mining sector hard.
But even with those lower average grades and higher costs, Barrick's sheer scale must still give them a powerful advantage, doesn't it?
Oh, absolutely. Don't underestimate the power of scale in this business. As of the end of 2024, they held a staggering 89 million ounces of proven and probable gold reserves.
89 million. That's a lot.
It's massive. And based on their current production guidance, that translates to an exceptionally long reserve life index. We're talking nearly 27 years.
27 years.
Yeah, that provides unparalleled long-term visibility and stability. It far exceeds many competitors and allows them to plan for decades, not just the next few years.
Incredible visibility. And okay, so they dig it up. What are they actually selling at the end of the day?
Their primary products are gold doré bars, that's like semi-pure gold bullion, straight from the mine site, and copper concentrate.
Okay.
And these are then sold to refineries and smelters around the world for further processing into the pure metals that end up in jewelry, electronics, or central bank vaults.
So, positioning them in the market, how does Barrick fit into the global competitive landscape? Are they really a top dog?
Definitely. By volume, Barrick is the world's second largest gold producer. Right after the big Newmont Goldcorp merger created the #1.
Second biggest. That's still huge.
It is. And that scale is a major advantage. It gives them economies and procurement buying power. It gives them unparalleled access to global capital markets. And critically, it gives them the financial muscle and technical expertise to undertake those multi-billion-dollar, decades-long development projects like Reko Diq that are simply beyond the reach of smaller players.
Okay, so distilling it down, their core value proposition for an investor, what does it really boil down to?
I think it's their ownership and operation of what they specifically define as Tier 1 mines.
Tier 1. What makes a mine Tier 1 in their book?
Okay, their definition is pretty clear. An asset with a mine life of at least 10 years, annual production over 500,000 ounces of gold, and importantly, total cash costs per ounce positioned in the lower half of the industry cost curve.
Quality, scale, and cost efficiency.
You got it. And Barrick currently operates 6 such assets. That concentration of quality is something very few peers can match.
6 Tier 1 mines.
Yes. And that portfolio is the absolute cornerstone of their strategy for generating sustainable, long-term free cash flow. It's a major competitive differentiator. Now let's widen the lens a bit. Consider the broader industry context. Barrick operates in commodity markets, which are cyclical, right?
Always up and down.
But right now, they're in very favorable precious and industrial metals markets.
Yeah.
We're seeing really powerful tailwinds from high commodity prices. Spot gold was over $3,300 an ounce in Q2 2025. Copper around $4.36 a pound.
That must be helping the bottom line significantly.
Oh, enormously. That high price environment directly translates to higher revenues and, assuming costs are managed, expanded profit margins for them.
And these high prices, do they seem like just a temporary blip, or is there something more structural going on?
Good question. It doesn't look fleeting, no. The current gold bull market seems structurally supported. You've got central banks buying aggressively, heightened geopolitical tensions everywhere you look, and those persistent inflation fears just won't go away.
Okay, so structural support for gold. What about copper?
Copper's demand side looks incredibly strong, underpinned by that multi-decade trend of global electrification.
Right, you mentioned VVs, renewables.
Exactly. Electric vehicles, renewable energy infrastructure, solar, wind, they all need vast amounts of copper. And now, add AI data centers to the mix. All this demand is creating a potential long-term supply deficit.
A deficit Barrick is trying to fill with projects like Reko Diq.
That's precisely the strategy. They're positioning themselves to meet that expected surge in copper demand.
Okay, makes sense. But even with high prices, those rising costs we talked about earlier must still be a constant battle.
Absolutely. Key cost drivers, energy, labor, consumables like cyanide or tires, they've all faced significant inflation since 2021. That directly drives up those AIC figures we discussed. Managing this inflation effectively is a constant battle, a major focus for all miners, including Barrick. And you can't talk about mining today without talking ESG, environmental, social, and governance factors.
Huge topic now. Critically important for investors, right?
Critically important. For investors, for lenders, for local communities, companies like Barrick face intense scrutiny over their emissions, their water usage, their relationships with local communities, tailings dam safety. The list goes on.
So a strong ESG program isn't just nice to have anymore.
No way. It's absolutely essential for maintaining their social license to operate, attracting investment, and securing the financing they need for these massive projects. It's table stakes now.
Who are Barrick's main rivals then? Who are they competing against day to day?
Their primary competitors are the other senior gold producers. Newmont Corporation, obviously, being the world's largest after their Goldcorp acquisition. Then there's Agnico Eagle Mines. They're highly regarded, especially for operational excellence and consistently low costs. They're often seen as the benchmark for efficiency.
Agnico, right. Anyone else?
Yeah, other significant players include Kinross Gold, AngloGold Ashanti. There's a handful of majors. And the competition isn't just about who produces the most ounces this quarter.
What else?
It's also fiercely competitive on cost efficiency, who can mine cheapest and, crucially, acquiring new high-quality assets or making discoveries. Good projects are rare and highly sought after.
And given where many of their mines are located, Africa, Latin America, that regulatory environment must be a constant headache or at least a major risk factor.
It's heavily regulated everywhere, even in Nevada. But you're right, the risk from changing laws, unexpected tax hikes, or frustrating permit delays is particularly acute in some of the developing nations where Barrick operates.
Like the situation in Mali right now.
Exactly. That can directly impact project economics, profitability, timelines. It's a significant operational risk.
It really sounds like large-scale gold mining isn't a business you can just jump into easily. The barriers to entry must be massive.
Immense. Truly immense. Think about it.
Yeah.
You need billions, literally billions of dollars in capital. It often takes over a decade just to go from discovering to first production.
A decade, wow.
Yeah. Plus, you need highly specialized geological expertise to even find the deposits. Then navigate incredibly complex government permitting processes. You need to secure that social license from local communities, which is harder than ever. And finally, you need deep institutional operational experience to run these massive, complex industrial sites safely and efficiently.
So not for the faint of heart or shallow of pocket?
Definitely not.
Yeah.
These are truly multi-generational projects requiring immense patience and expertise.
Okay.
Shifting focus slightly to Barrick's specific competitive advantages. What sets them apart? Well, first, their brand strength. Being one of the largest and longest operating senior gold miners certainly helps. It aids in attracting top geological and engineering talent, securing partnerships with governments or other companies, and importantly, accessing those global capital markets on favorable terms. Size and reputation matter.
And on the cost side, we touched on this. They're competitive, but maybe not the absolute lowest cost producer out there.
That's a fair summary. Their sheer scale definitely allows them to operate consistently within the lower half of the industry cost curve. Is that good?
Can you remind us of those numbers?
Sure. Barrick's Q2 2025 AISC was $1,684 per ounce. Their guidance for the full year 2025 is in that $4,460 to $1,560 range. Now compare that to Agnico Eagle.
The cost leader.
Yeah, they came in at $1,289 in Q2. So Barrick is competitive, yes, but Agnico is clearly the cost leader right now. It highlights areas where Barrick still has room to improve its operational efficiency.
But didn't you mention they recently showed some improvement in their own costs quarter over quarter?
I did, and that's an important point. Barrick's Q2 AISC figure actually represented a significant 5% decrease from its Q1 2025 number, which was higher at $1,775 per ounce.
Okay, so costs came down from Q1 to Q2.
Yes. That sequential improvement is definitely a positive sign. It demonstrates management's ability to actively control and reduce costs, suggesting that maybe that Q1 spike was more transient, not a permanent new level. It shows they're working on it.
Right. Now, in a commodity business like mining, I wouldn't expect things like network effects or high switching costs to be major competitive advantages, are they? Customers can buy gold from anyone.
That's generally correct. Since gold and copper are global commodities sold at basically the same market price regardless of who mined it, those kinds of advantages aren't typically sources of a competitive moat for miners. Their advantage comes from the quality of their assets and their operational skill. And that brings us back to what is arguably Barrick's most significant unique asset,
Hmm.
that portfolio of 6 Tier 1 gold mines.
Right, the big, long life, low cost ones.
Exactly. We're talking giants like Carlin and Cortez in Nevada, the backbone, Pueblo Viejo in the Dominican Republic, and those highly productive African assets, Loulo-Gounkoto in Mali and Kibali in the DRC.
That collection sounds impressive.
It is. This collection of world-class operations provides a stable, highly profitable production base that is incredibly difficult for competitors to replicate quickly. It's the bedrock of their value.
And finally, on strategy, their approach to hedging, protecting against price drops, that's changed under the current leadership, hasn't it? It aligns more with how many gold investors think.
Indeed. Under the current leadership of CEO Mark Bristow, Barrick has largely moved away from hedging its gold production. They used to do a lot more of it.
Why the change?
The philosophy now is to give shareholders sole, unhedged exposure to the upside of the spot gold price. This aligns perfectly with why many investors buy gold mining stocks in the first place. They want that leverage to a rising gold price. They don't want the miner hedging away the potential gains.
Makes sense. Give the investors what they came for. Chapter 2. Management Evaluation. The Bristow Doctrine. Okay, let's talk management, because the story of Barrick's recent transformation, you really can't tell it without focusing on one central figure, Dr. Mark Bristow. Tell us a bit about his background and the impact he's had.
Yeah, Dr. Mark Bristow, he's a geologist by training, which I think is important, and he has this truly formidable reputation in the mining world.
He built Randgold, right?
Famously, he founded Randgold Resources and built it from scratch into one of the most respected gold miners globally. They were known for discovering and developing really high-quality assets, primarily in Africa, places others were wary of. His track record is just one of consistent value creation through disciplined operations and, critically, exploration success.
And he didn't exactly waste time shaking things up at Barrick after the merger with Randgold, did he?
Not at all. It was quite dramatic. His tenure officially began in January 2019, following the merger. And within just a few months, boom, he orchestrated that landmark Nevada Gold Mines joint venture with Newmont.
That NGM deal was huge news, combining forces in Nevada.
It was massive,
Yeah.
a bold move. It created the largest gold mining complex in the world, with Barrick as the majority owner and the operator. It effectively ended decades of, frankly, inefficient competition between the two giants in Nevada's Carlin Trend.
Unlocking synergies, as they say.
Exactly. It unlocked enormous synergies and demonstrated his highly pragmatic, value-focused, and sometimes ruthless approach to management. Get the deal done if it makes sense.
His leadership style sounds very hands-on, very operations-focused, and he's certainly facing a real test right now with the situation in Mali, isn't he?
He absolutely is. His very hands-on, boots-on-the-ground, operations-focused style is being severely tested in real time right now.
Yeah.
In mid-2025, as we know, the Malian government placed the Loulo-Gounkoto mine complex, which is a key Tier 1 asset for Barrick, under the control of a provisional administrator amid a dispute.
That sounds serious. State control.
It is serious. This is a very public, very severe test of Barrick's ability to manage extreme geopolitical risk. How this gets resolved will be a defining moment for his tenure and, frankly, for the company's valuation and reputation. Bristow is also known for a communication style that's, well, let's call it exceptionally direct. Transparent, yes, but often quite blunt. No sugarcoating.
Tells it like it is.
Pretty much. And you see that reflected in Barrick's quarterly reports. They're notably detailed, providing really granular operational data. This culture of accountability, of laying it all out there, is a hallmark of what people call the Bristow Doctrine.
And ethically, operating in tough places requires strong policies.
Absolutely. Barrick operates under a formal code of business conduct and ethics. They adopt the World Gold Council's conflict-free gold standard. And they have robust policies on anti-bribery and human rights. These aren't just pieces of paper. They're essential frameworks for operating credibly in complex jurisdictions.
Okay, let's shift to capital allocation, how they spend their money. Barrick, under Bristow, has clearly made a deliberate break from some past strategies, hasn't it? What exactly did they repudiate?
Oh, completely. They totally repudiated the old growth at any cost strategy that characterized Barrick in the past. The most infamous example, the one everyone points to, was the disastrous $7.2 billion acquisition of Equinox Minerals back in 2011.
Right, the copper play that went sour.
Exactly. It led to massive write-downs, huge shareholder value destruction, and became a symbol of undisciplined M&A. Bristow basically said, never again.
So what's the new strategy for deploying capital under Bristow? If not big M&A, then what?
The new strategy is laser-focused. It's defined by a relentless focus on organic growth and extremely disciplined investment in their existing portfolio of assets.
Organic growth meaning?
Meaning finding more gold or copper right next to their existing mines. That's called brownfields exploration, and they're doing it aggressively, or funding the expansion of current operations and funding those large-scale, long-term internal growth projects we mentioned.
Like Reko Diq and Lumwana.
Exactly. The Reko Diq copper-gold project in Pakistan and the Lumwana super pit expansion in Zambia, these are multi-billion-dollar, multi-decade internal projects. It shows a much more patient, long-term, build-it, don't-buy-it approach to growth.
And alongside investing, they're also selling off assets that don't fit that Tier 1 strategy. That sounds disciplined, too.
Yes, very much so. Portfolio optimization is key. In 2025 alone, Barrick sold its 50% stake in the Donlin Gold project up in Alaska for $1 billion. They also divested their Alturas exploration project.
Clearing the decks.
Pretty much. It reinforces their commitment to focusing capital, management attention, and resources on their very best Tier 1 assets. It aligns perfectly with a true value investing philosophy. Focus on your best ideas.
Okay, let's talk shareholder returns. It sounds like they have a pretty generous and, again, disciplined framework.
Yeah.
How does that dividend work exactly?
Yeah, their dividend policy is interesting. It actually has two components. There's a base dividend, which is designed to be sustainable even at lower gold prices.
Okay, a reliable floor.
Right. And then on top of that, there's a performance dividend, which is explicitly linked to the company's net cash position on the balance sheet.
So when the company does well financially, the dividend goes up.
It's exactly more cash, higher performance payout. For Q2 2025, for example, the total dividend was $0.15 per share. That included a very high performance component because their balance sheet was strong. It directly links shareholder returns to the company's financial health in a very transparent way.
15 cents quarterly. And they're also buying back a lot of their own shares, aren't they? That often signals management thinks the stock is cheap.
That's typically a very strong signal, yes. And Barrick has been active. In Q2 2025 alone, they repurchased $268 million worth of their shares.
Wow.
And over the last 12 months leading up to that, total buybacks amounted to a really substantial $860 million.
$860 million in a year.
Yeah. And they're not done. They've authorized a further $1 billion share buyback program for the rest of 2025. This consistent, large-scale return of capital via buybacks absolutely underscores management's belief that their shares are trading below what they think they're intrinsically worth. Okay, one more metric on management effectiveness. Return on invested capital, or ROIC. Super critical measure for a capital-intensive business like mining. How well are they using the money invested?
Right. How's Barrick doing there?
Barrick's trailing 12-month ROIC is currently 8.38%. The normalized figure, smoothing things out a bit, is 7.33%.
Is that good? Bad? Average?
It's solid. It represents decent performance and definite improvement from where they were years ago. However, it still lags some of their higher quality peers.
Like Agnico Eagle again?
Like Agnico Eagle, yes, which sits way up at 11.47%. And even Kinross Gold is higher at 13.02%. So while Barrick's ROIC is respectable and improving, it indicates there's still room for them to enhance their capital efficiency and really catch up to the best-in-class operators on that metric.
Chapter 3, Financial Analysis, Gauging the Financial Fortress. All right, let's dive into the numbers. Looking at Barrick's 5-year financial summary, what story does their revenue growth tell us? Does it clearly show that commodity cycle impact?
Oh, absolutely. You can see it plain as day in the numbers. Revenue peaked significantly in 2024, hitting over $12.9 billion. Why? Driven almost entirely by those record gold prices we saw.
Big top-line number. What about margins?
Well, you also see the volatility there. Gross margins, operating margins, net margins, they fluctuate quite a bit year to year. That reflects both the benefit of high prices, but also the hit from cost inflation we discussed. It's the classic commodity producer pattern. Volatile, but hopefully profitable through the cycle. Barrick has clearly demonstrated an ability to capitalize strongly when prices are high.
Okay. And free cash flow FCF, which is so important for value investors, the actual cash left over, how has that metric fared for Barrick?
Free cash flow generation has been robust overall, but again, you see that volatility mirroring the margin trends. It was a massive $3.4 billion back in 2020 when gold prices first surged and costs hadn't fully caught up.
$3.4 billion. Impressive.
Very. Then it declined to a low point in 2022 during that period of peak cost pressure, but then it recovered nicely to $1.3 billion in 2024.
And how's 2025 looking so far?
Strong, trend continuing. Crucially, they've already generated $770 million in free cash flow in just the first half of 2025 alone.
Halfway there to beating 2024's number already.
Exactly. That indicates a really strong underlying performance this year. And remember, this growing SCF is what directly fuels those dividends, those buybacks, and allows them to keep strengthening the balance sheet by paying down debt.
Speaking of stability, how consistent are Barrick's earnings over time? Can investors rely on them year in, year out?
Well, consistent isn't really the right word for earnings in a commodity producer like Barrick. They are inherently cyclical. They swing with metal prices. You won't see steady, predictable EPS growth like in, say, a software company.
So earnings will be lumpy.
Very lumpy. However, the key thing for a long-term investor isn't year-over-year consistency. It's their demonstrated ability to remain profitable and, more importantly, generate positive cash flow throughout the entire price cycle, even during the tougher periods when prices dip. And Barrick has consistently achieved that under Bristow. They stay in the black.
Okay, profitable through the cycle. Now, their balance sheet, you hear it described as a fortress balance sheet. Is that just marketing speak, or is it truly that strong?
No, it's absolutely legit. Barrick's balance sheet is arguably a core investment pillar right now, and a significant differentiator compared to many peers, and even its own past.
What makes it so strong? Low debt.
Very low debt, yes. Their debt-to-equity ratio is down to a very comfortable 14.08%. That means their assets are primarily financed by equity, not borrowed money, which reduces financial risk dramatically.
Okay, low leverage. What about liquidity? Cash on hand.
Exceptionally strong liquidity. Their current ratio, which measures short-term assets against short-term liabilities, is 2.87. Anything over 1 is good, over 2 is strong. Almost 3 is fantastic. It indicates they have more than enough cash and equivalents to cover all their near-term obligations comfortably. It provides a really robust buffer against any unexpected downturns or operational hiccups. But here's a really crucial differentiator, something that doesn't get enough attention maybe. Barrick has no major debt repayments due until 2033.
Not until 2033. That's almost a decade away.
Exactly. This long-dated maturity schedule is a huge strategic advantage. It gives them incredible financial flexibility. They don't have refinancing pressure hanging over them. They can confidently fund those massive, long-term growth projects like Reko Diq without worrying about near-term debt maturities.
That seems like smart financial management.
Very smart. And perhaps the most remarkable achievement, the real cherry on top. By the end of Q2 2025, Barrick actually achieved a net cash position of $73 million.
Net cash, meaning more cash than debt.
Precisely. More cash and cash equivalents on hand than total debt outstanding. That's a dramatic turnaround from being in a net debt position just 1 quarter prior. Achieving net cash truly signifies a fortress balance sheet, especially for a company of this scale in this industry. It's almost unheard of.
Okay, fortress balance sheet confirmed. So after digging through all that financial detail, the operations, the management, the strong financials, we circle back to the big question, the core mystery we started with. Is Barrick Mining actually a bargain at its current price?
It certainly seems that way when you look at valuation, yes. Let's look at some relative valuation metrics compared to peers.
Okay, how does it stack up?
Well, its trailing 12-month price to earnings, or PE ratio, is around 15.86. That's competitive, maybe slightly below peers, but it doesn't immediately scream deep undervaluation on its own.
Okay, PE is decent. What about price to cash flow?
Now, price to cash flow, or PCF, that's more telling. Barrick's PCF ratio is currently 6.34. Compare that to Agnico Eagle at 13.35, or even Kinross at 8.32.
So Barrick's is significantly lower. You pay less for each dollar of cash flow.
Significantly lower, yes. Investors are paying considerably less for Barrick's cash flow compared to key competitors. That's a strong indicator of potential undervaluation right there.
But for a mining company, the really critical valuation metric, the one that tries to value the actual assets in the ground, is the price to net asset value ratio, the PNAV. What does that tell us about Barrick?
You're spot on. PNAV is king in mining valuation. And this is where the Barrick story gets really, really interesting and that discount becomes starkly clear.
Lay it on us.
Barrick currently trades at a price-to-net asset value of just 0.61 times, 61 cents on the dollar of its estimated asset value.
0.61x NAV. How does that compare to peers?
Its senior peers, on average, trade around 1.19 times NAV. almost double Barrick's multiple.
Wow, that is a massive discount. So the market values Barrick's assets at barely 60% of what analysts think they're worth, while peers trade above their estimated NAV.
Precisely. It suggests incredibly deep market pessimism about Barrick's risks, or its ability to realize the value of those assets. Now, some analysts did a stress test.
What did they find?
They basically said, okay, let's assume the worst. Let's value Barrick's highest risk assets. Loulo-Gounkoto in Mali, Reko Diq in Pakistan at 0, wipe them off the books.
Okay, a harsh scenario.
Very harsh. Even under that scenario, Barrick's P/NAV would only rise to about 0.70x. Still a huge discount to peers.
So even if you write off the risky stuff entirely, the market is still applying a steep discount to Barrick's core, stable North American assets compared to how it values similar assets owned by competitors like Newmont or Agnico.
Exactly. That's the key insight. The discount runs deep, even into the perceived safe parts of the portfolio. This absolutely presents a classic margin of safety scenario for a potential value investor. The market is essentially screaming, we don't believe in Barrick's ability to manage its risks and extract the full value from its asset base, even the good parts.
Fascinating. Okay, so relative valuation screams discount. What about intrinsic valuation? Trying to calculate what the company is actually worth based on future cash flows using a discounted cash flow or DCF model. Can you give us the quick explanation of how that works?
Sure. The DCF concept is pretty intuitive at its core. A business's intrinsic value is basically the sum total of all the cash it can generate for its owners over its entire lifetime, but discounted back to what that cash is worth today. Because a dollar tomorrow is worth less than a dollar today, right?
Right. Time value of money.
Exactly. So for a miner, that involves forecasting future production levels, future metal prices, gold and copper, and future operating costs for each and every mine they own, often for decades out. You calculate the projected free cash flow from all that, and then you discount those future cash flows back to the present using an appropriate discount rate that reflects the risk. Sum it all up, and that's your estimated intrinsic value.
Complex process, lots of assumptions.
Very complex, definitely involves assumptions, but it's the most fundamentally grounded way to estimate what a business is truly worth.
Okay, so based on a reasonable, maybe conservative, educational DCF model, what's the estimated intrinsic value range for Barrick? Does it support the undervaluation thesis?
It absolutely does. Based on a conservative DCF model, and we need to stress this is educational, not investment advice.
Yeah.
Barrick's intrinsic value appears to be significantly higher than its current share price. We estimate a likely range of somewhere between $28 to $34 per share.
$28 to $34 per share, compared to the current price around $21.
Yes, exactly. That suggests a potential upside of roughly 30% to 60% from the current share price of $21.16. So yes, the DCF analysis strongly reinforces that undervaluation thesis suggested by the low P/NAV multiple. There seems to be a significant gap between price and estimated value.
That's a substantial potential upside. What are the key, maybe conservative assumptions you baked into that DCF model to arrive at that $28, $34 range? Because assumptions matter hugely here.
They absolutely do, and transparency is key. We use long-term normalized commodity price assumptions that are well below current spot prices.
Okay, not assuming today's high prices last forever.
Definitely not. For example, we use something like $2,200 per ounce for gold long-term versus the current spot price around $3,370. For copper, maybe $3.75 per pound long-term versus the current spot around $4.36. So conservative on prices.
Makes sense. What else?
We also used a relatively high discount rate, somewhere in the 8% to 10% range. That's higher than you might use for a less risky business. And it's meant to explicitly account for the unique risks inherent in mining operational risks, cyclicality, and especially that geopolitical exposure Barrick faces.
Building in a buffer for risk.
Right. And finally, we used a very conservative terminal growth rate of only 0% to 1%. That basically assumes that beyond the explicit forecast period, the company can, at a minimum, just replace its reserves and maintain production, but not grow significantly forever. It avoids baking in overly optimistic long-term growth.
So conservative on prices, conservative on risk, conservative on long-term growth, and still getting a significant potential upside.
That's the finding. Even with these quite conservative assumptions built into the model, the calculated intrinsic value suggests a clear and substantial undervaluation compared to the current market price.
Chapter 4, Market Sentiment. Okay, let's move into part 2. We've covered the business, management, and financials. Now, what's the market actually thinking? What's Wall Street saying about Barrick? What are the analyst price targets and the overall consensus view?
Well, the overall analyst consensus rating for Barrick stock is currently a moderate buy. So generally positive, but maybe not a table-pounding strong buy from everyone.
Okay, moderate buy and price targets.
The average one-year price target from analysts covering the stock is approximately $25 per share.
$25. So compared to the current $21.16, that suggests about 18% potential upside over the next year, according to the average analyst.
That's right, about 18% upside baked into the consensus target. And it's worth noting, their Q2 2025 earnings per share forecast was pretty much spot on. They predicted $1.47, and that's what Barrick reported. So the market clearly anticipated their strong recent financial performance. The numbers themselves weren't a huge surprise.
Interesting. But despite that moderate buy and accurate earnings forecast, the news headlines often seem to tell a different story, don't they? There feels like a real disconnect between the solid fundamentals and how the company is sometimes portrayed.
They absolutely do. You see this split personality in the coverage. On one hand, you get positive stories focusing on the strong earnings, the robust free cash flow, the benefit of high gold and copper prices, plus positive updates on development projects like Reko Diq.
The good news.
The good news.
Uh-huh.
But then there's this persistent negative undertone that often dominates the headlines, focusing almost entirely on geopolitical risk. Specifically, that ongoing dispute in Mali involving Lulugunkoto.
So the Mali situation casts a long shadow.
A very long shadow. It seems to be the main factor causing the stock to lag behind the broader gold price rally we've seen. Peers without that specific headline risk have often performed better. It's a very clear disconnect. Solid underlying business performance versus negative market perception driven by geopolitical fears.
Okay, what about short interest? As a gauge of bearish sentiment, are lots of sophisticated investors actively betting against Barrick?
That's a great metric to check. And the answer is no, not really. Barrick currently has very low short interest. It's less than 1% of its free float. The share is available for trading.
Less than 1% short. That's tiny for a large company.
It's very low. It indicates there's no significant concerted effort by short sellers to bet heavily against the company. It suggests that despite all the negative headlines about Mali, very few large, sophisticated investors are actually willing to put their capital behind a belief that the stock is set for a meaningful decline from its current levels. Lack of short interest can be its own bullish signal.
Interesting. So the smart money isn't aggressively shorting it. Now, technically, how's the stock actually behaving on the charts? What are the moving averages telling us?
Technically, the picture looks quite strong, actually. Barrick is currently trading comfortably above both its 50-day simple moving average that sits around $22.30 and its 200-day simple moving average, which is lower at $21.49.
So above both key short-term and long-term trend lines.
Correct. And furthermore, there was a significant technical event back in April 2025, a golden cross.
Ah, the golden cross. What is that again?
That's when the shorter-term 50-day moving average crosses above the longer-term 200-day moving average. It's generally considered a bullish technical signal, often indicating the start or confirmation of a longer-term uptrend.
So the technical chart pattern looks bullish.
It points to a technically strong and bullish uptrend for the stock, yes, which again contrasts sharply with some of those negative news narratives and especially with that deep valuation discount we discussed. The price action itself seems to be telling a more positive story than the headlines.
Chapter 5. Ownership Structure. Let's look at who actually owns Barrick. What does the stakeholder analysis, the ownership structure, tell us about investor confidence in the company? Are the big players holding on?
Yeah, looking at the shareholder base is always revealing. Barrick's ownership is dominated by large, sophisticated institutional investors. We're talking about roughly 68.6% of the shares being held by these big firms.
Like who? Any familiar names?
Oh yeah, big names like Wellington Management, Vanguard, Van Eck Associates, BlackRock. The usual suspects among major global asset managers.
Okay, so the big institutions are heavily invested.
Very heavily. And Van Eck's significant position is particularly noteworthy. They manage the GDX Gold Miners ETF, the biggest one.
Ah, so GX has to own Barrick.
Pretty much. As a major component of the index GDX tracks, Van Eck needs to hold a large position, ensuring a consistent baseline level of passive demand for Barrick shares, regardless of sentiment. But beyond that, the presence of all these large, typically long-term oriented capital allocators generally suggests a high degree of underlying confidence in the company's long-term strategy and its fundamental value proposition. They wouldn't hold such large positions if they didn't see long-term merit. Now, what about insiders? Management, the board, Are they buying or selling? What are they doing with their own money?
Good question. What's the insider activity look like?
Well, insider holdings themselves are around 0.6% of total shares outstanding. That's fairly typical for a company of this enormous size. Founders or early investors are long gone. But here's the really crucial detail, the powerful signal.
Okay.
In the past 90 days leading up to our analysis date, there have been zero reported insider trading transactions. None.
Zero buying, zero selling.
Zero reported buys, zero reported sells. Now think about what happened in those 90 days. You had a strong stock rally off the lows, and you had the Mali crisis escalating significantly.
Lots of volatility in news.
Exactly. The complete absence of selling by the company's most informed participants, the CEO, Mark Bristow, the CFO, the board members, during this period of both rising prices and peak uncertainty serves as a really powerful nonverbal signal.
What's the signal?
It strongly suggests their confidence that, despite the challenges, the stock remains fundamentally undervalued and that the current issues, like Mali, are ultimately navigable. If they thought things were truly dire or the stock was overpriced, you'd expect to see some insider selling, wouldn't you?
Yeah, you probably would. That lack of selling speaks volumes. And is there any single controlling entity? One group calling the shots?
No, that's correct. Ownership is quite diffuse among those many institutions and retail investors. There's no single controlling shareholder. This ensures that the company is managed, in theory, for the benefit of all shareholders, overseen by an independent board of directors who represent everyone's interests.
Chapter 6, Risk Assessment.
All right, let's try to pull together the risks and opportunities using a classic SWOT analysis framework. Strengths, weaknesses, opportunities, threats. Starting with strengths, what are Barrick's core advantages?
Okay, lay them out.
First, that Tier 1 asset portfolio we keep mentioning. 6 world-class, long-life, low-cost operations. That's a huge strength few peers can match. Second, that fortress balance sheet. Net cash position, very low leverage, no major debt repayments due until 2033. Incredible financial stability.
Got it. What else?
Third, the proven management team led by Mark Bristow. Controversial maybe, but with a strong track record of operational discipline and value creation. And fourth, that exceptional reserve life, nearly 27 years of production visibility based on current reserves. That's unparalleled.
Okay, those are some powerful strengths. What about the flip side? What are their weaknesses?
The most significant weakness, the elephant in the room, is definitely Barrick's geographic concentration of risk.
Meaning too much production in risky places.
Exactly. A substantial portion of its production and future growth via reserves is located in politically or socially sensitive jurisdictions. We're talking Mali, the DRC, Tanzania, the Dominican Republic. This directly exposes them to the risk of resource nationalism, sudden tax changes, or instability.
Right, like the Mali situation exemplifies. Any other key weaknesses?
Well, as we discussed, while their all-in sustaining cost structure is competitive, it's consistently not best in class. It's generally higher than Agnico Eagle's. This indicates there's still room for operational improvement and efficiency gains to really reach that top tier of cost performance. Okay, let's move to opportunities. What could go right for Barrick? First, the ongoing strong commodity price environment. Continuing bull markets in both gold and copper provide a massive potential tailwind for their profitability. High prices solve a lot of problems.
True. What else?
Second, that transformational growth pipeline. Projects like Reko Diq and the Lumwana expansion are expected to significantly increase Barrick's copper production and boost overall gold equivalent output by maybe 30% by the end of this decade.
Becoming a major copper player just as demand might soar.
That's the plan. Perfect timing, potentially. Third, there's still major exploration upside, particularly at the 4 Mile project down in Nevada. Many believe that has the potential to become Barrick's next Tier 1 asset, discovered right near their existing infrastructure.
Another Tier 1 in Nevada would be huge.
Huge. And finally, the big one. The opportunity for a significant valuation re-rating. There's potential for the market to finally close that substantial P/NAV discount we talked about. What could trigger that? Maybe a positive resolution of the Mali dispute? Or perhaps the market starting to fully appreciate and value Barrick's emerging copper growth story. Either could be powerful catalysts.
Okay, lots of potential upside. Now, the scary part. What are the major threats facing Barrick?
The most obvious threat is simply commodity price volatility. They benefit hugely from high prices, but a sharp, sustained downturn in gold or copper prices would directly hammer their revenues, cash flows, and profitability. That's inherent to the business.
Standard cyclical risk. What else?
Geopolitical instability. This is clearly the most acute and immediate threat right now. The Mali crisis with Lulu Gunkodo under state administration is a direct, tangible example of this risk materializing. And similar risks, maybe less immediate but still present, exist in Pakistan with Reko Diq and potentially in the Dominican Republic, depending on political winds.
That geopolitical risk feels like the biggest overhang.
It absolutely is. Then there's the threat of cost inflation rearing its head again. If energy, labor, or consumable costs spike unexpectedly, it would directly impact their AISC and squeeze margins, even if metal prices stay high. And finally, a newer potential threat: the impact of those U.S.-imposed tariffs from 2025.
How could tariffs affect Barrick?
Well, they could potentially increase the cost of imported mining equipment or supplies. And perhaps more subtly, they could lead to retaliatory measures or just generally sour relations with some of the host countries where Barrick operates, adding another layer of geopolitical tension. It's something to watch.
Chapter 7, Conclusion. Okay, we've covered a lot of ground. Let's try to synthesize all these findings. Boiling it down, what's the essential bull case for Barrick Mining? Why should an investor consider buying this stock despite the risks?
The bull case is actually pretty compelling, fundamentally speaking. The argument is this: an investor today can buy a truly world-class portfolio of mining assets, led by a proven and highly disciplined management team at a deep, deep discount to both its peers and its estimated intrinsic worth.
The value proposition.
Exactly. You get that fortress balance sheet, which is funding transformational organic growth, particularly in copper, perfectly timed, arguably, for a looming supply deficit. All this is happening amidst a strong underlying bull market for both gold and copper.
So good assets, good management, good balance sheet, good growth, good macro backdrop.
Right. And the bulls would argue the market has overly penalized Barrick for the geopolitical risk. They'd say the current price effectively gives you the high-risk, high-reward assets in places like Mali and Pakistan almost for free, and is still discounting the value of the stable, core North American assets relative to peers. It's presented as a classic value investment opportunity born from excessive fear.
Okay, that's the bull case. Now, play devil's advocate. What's the bear case? Why are investors potentially right to be skeptical and keep that stock price relatively low?
The bear case centers entirely on the argument that those geopolitical risks are very real, potentially even understated by the bulls. The Mali crisis isn't theoretical. It's a tangible, ongoing example of resource nationalism potentially crippling a key asset.
The risk is real, not just perceived.
Exactly. Bears would argue the Reko Diq project in Pakistan, while huge, represents a multi-decade bet on a historically fragile political and security environment. That's a massive gamble. Furthermore, the huge capital expenditure required for these growth projects carries significant execution risk delays. Cost overruns are always possible.
What's the nightmare scenario for bears?
The nightmare scenario, the perfect storm for bears, would be a combination of a sharp commodity price downturn coinciding with escalating geopolitical conflicts, perhaps leading to the permanent loss or significant impairment of a major asset like Lulu Gunkodo. That could trigger massive write-downs and cause the stock to decline sharply, proving the current discount was indeed rational or even insufficient.
So a potential value trap if the risks fully materialize. Okay, let's bring it back to valuation one last time. What's the bottom line number-wise?
The bottom line is that clear disconnect we keep highlighting. Barrick's current share price, around $21.16 as of our analysis date, trades at a substantial discount to our estimated intrinsic value range of $28 to $34 per share, calculated using conservative assumptions. That suggests, quantitatively, a significant margin of safety if those major risks are successfully managed or resolved favorably.
So after all this analysis, what does this really mean for you, the learner, the potential investor considering Barrick?
Ultimately, the investment decision for Barrick Mining really hinges on your individual assessment and, crucially, your personal tolerance for geopolitical risk. The quantitative data, as we've laid out, is undeniably compelling.
Undervalued, financially strong.
Right, fundamentally undervalued, financially robust, possesses clear organic growth pathways, led by best-in-class management in many respects, and offers generous shareholder returns through dividends and buybacks. The numbers look good. However, the qualitative risks, the political risks in Mali, Pakistan, DRC, Dominican Republic, are absolutely real and material. They cannot be ignored or wished away. That discount to peers we see in the market, that is the market's current price tag for that uncertainty. The question is whether you think that price is too high or too low.
To help frame potential outcomes, maybe we can outline a brief scenario outlook. what might happen.
Sure, that could be helpful. Let's think about three possibilities. Our base case scenario might be that metal prices remain elevated, maybe not at record highs, but strong, and the geopolitical situation remains tense, particularly in Mali, but ultimately doesn't lead to a permanent loss of a major asset. Negotiations continue. In that case, the stock likely drifts higher over time, gradually closing some, but maybe not all, of that valuation gap as uncertainty lingers but disaster is averted.
Okay, a gradual grind higher. What's the optimistic bull case?
The bull case would involve gold and copper bull markets, continuing or even accelerating, and achieving a favorable definitive resolution in the Mali dispute, restoring confidence in that asset. That would be a powerful dual catalyst. You could see a rapid re-rating of the stock towards its intrinsic value as both earnings estimates rise and the geopolitical risk premium collapses.
Significant upside potential there. And the pessimistic bear case.
The bear case, the nightmare scenario we touched on, involves something like a permanent loss or nationalization of the Lulu Gunkodo complex in Mali, perhaps combined with the sharp downturn in commodity prices. This would likely lead to significant asset write-downs, a major hit to earnings and cash flow, and probably a sharp decline in the stock price, potentially well below current levels. So, wrapping it all up, what does this mean for you, the learner? I think understanding Barrick is really a masterclass in evaluating that constant push and pull in investing, the tension between powerful fundamental value on one side and equally powerful external risks on the other. The core question for you isn't just about what Barrick is today based on the numbers, but what you as an investor believe it can be in the future, once the market fully weighs, digests, and perhaps resolves these critical risk factors.
A fascinating case study indeed. If you're enjoying these deep dives and want to continue getting this kind of in-depth analysis on mining stocks and other investments, please make sure to like this video and subscribe to the One Trillion's YouTube channel.
That's right.
We plan to cover all major mining companies eventually, and we really do take requests for stocks in the precious metal space, so leave your suggestions in the comments below.
And now for the necessary disclaimers. This analysis was generated by an AI system for educational purposes only and should absolutely not be considered financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions based on this or any other information.